Thank you so much again for checking in today. My name is Agabus. I'm a financial educator here on the YouTubes, and today we've got an article a few weeks old from CNBC, but we're going to talk a bit about the banking industry. Now, for those of you who haven't been paying attention, this year we've seen some major collapses with banks earlier in the year, which is on pace so far to repeat a 2008 banking crisis. So let's take a look and see what CNBC has to say today. Fitch, which is one of the credit rating companies, warns it may be forced to downgrade dozens of banks, including the big guy, JP Chase. Fitch Ratings cut its assessment of the banking industry's health at large in June, a move that some analysts say went largely unnoticed because it doesn't trigger any downgrades on the banks. But another one-notch downgrade of the industry score from AA- to A+ would force Fitch to reevaluate ratings on each of more than 70 banks that it covers, according to Wolf. And it says here, according to Wolf, if we were to move to A+, then that would recalibrate all of our financial measures and would probably translate into some negative rating actions. Let's see what else I have to say. The article continues, a Fitch Ratings analyst warned that the U.S. banking industry has inched closer and closer to another source of turbulence. The risk of sweeping rating downgrades on dozens of U.S. banks, which could also include JP Chase. But another one-notch downgrade of the industry's score, Fitch would have to reevaluate ratings again on more than 70 U.S. banks. The credit rating firms have relied upon a lot of bond investors. And last week, this was back in August here, Moody's downgraded 10 other small and mid-sized banks and warned that cuts could come for another 17 lenders, including some larger companies like Truist and U.S. Bank. Just the other week, if you haven't noticed, weren't paying attention, Fitch downgraded the United States long-term credit rating because of political dysfunction and growing debt loads, a move that was derided by business leaders, including J.P. Morgan's CEO, Jamie Dimon. Very rare for a credit rating agency to downgrade the United States. Has not happened very often. Now, the downgrading affects all of the debt and credit that gets lended out in the United States. Now, some of the concerns with the downgrading of the banks and of the U.S. debt is that if the country's two largest banks by assets, JP Morgan and Bank of America, would have to be cut as well because, according to the article, banks can't be rated higher than the environment in which they operate. And if these two banks are also cut, it would force it would force Fitch to also consider downgrades to the rest of the peers in the industry, which could push some of the weaker lenders into non-investment grade status. Why is that a concern if these bonds and the credits are non-investment grade status? Well, it creates a higher risk that the bonds are able to be repaid. As we continue through the article here, we talk about rates and defaults. Now, the biggest issue we're seeing is that the path of interest rates determined by the Federal Reserve. Now, some forecasters are saying and predicting that interest rate raises are done, could be cut sometime next year. However, there are some who are saying that the rates will continue by the end of the year to go up. And if this happens, defaults tend to rise in rate hiking environments. It's not shocking, again, according to the article here. But if we're exceeding normalized losses, that is what maybe tips us over. The impact on the downgrades is hard to predict. But in the wake of Moody's cuts, Morgan Stanley analyst says that downgraded banks would have to pay investors more to buy their bonds, which also compresses profit margins. It makes it harder for banks to make money. It's not inevitable to know exactly what could happen, but the downgrades that they say could also trigger unwelcome provisions in the lending agreements or other complex contracts. We shall see how this story plays out and what interest rates are like by the end of the year. And if you like the content, again, subscribe, like, comment below. Thank you so much for watching. We will see you next time. Stay inquisitive, stay curious, stay educated.